Good morning and welcome to the street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, John Zechner, chairman at J. Zechner Associates, will be joining us for the hour. In 30 minutes, we'll discuss the economic impact of the FIFA World Cup, even though hotel bookings haven't surged. We'll chat with the president and CEO of the Greater Toronto Hotel Association. And we want to hear from you this morning on First Call. Reach out with your questions on North American large cap stocks, and we'll have John answer as many of them as he can at the end of the show. Number to call, 1-855-326-6266. We'll open the phone lines in about a half hour. Our email address, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. American firm Northern Oil and Gas is acquiring a stake in Calgary-based Parallax Energy. The $350 million cash and stock deal between the two privately held companies will give Northern a 25% interest in light oil producing properties and 75,000 acres in the Duvernay Shale Basin in Alberta. Under the agreement, Parallax will continue to operate the assets owned by Northern. Canada is working on a comprehensive deal with India to boost trade and investment. This comes as Indian Commerce and Industry Minister Piyush Goyal is in the midst of a three-day visit. Goyal met with Prime Minister Mark Carney in efforts to strengthen the bilateral ties. Carney says a deal with India would be a game changer for Canadian businesses and workers. The two sides say they hope to conclude a deal by the end of the year. How about this number? The combined federal and provincial debt is expected to reach $2.4 trillion. The Fraser Institute says debt has grown substantially since the 2008 financial crisis. The combined government's debt now equals about 75% of the Canadian economy. Manitoba has the highest combined debt share of the economy, while Alberta's provincial debt as a share of the economy remains the lowest. And now our top line story. U.S. futures are rising as investors remain hopeful that recent strikes on Iran will not disrupt peace talks in the Middle East. You can see, look at the NASDAQ, of course, closed for the holiday yesterday. So a lot of pent-up reaction there. The market's signaling a possible rebound. Tech stocks leading gains even as the geopolitical tensions continue. For more, let's bring in our guest for the hour, John Zechner, chair at J. Zechner Associates. John, always a pleasure to have you, sir. How are you?
Hey, good morning, Roger.
Another interesting day. I mean, the weekend, a lot of optimism. It was the holiday for the Americans yesterday, so there's some pent-up spending wanted and buying needs there. But then we have the strikes, and yet nobody seems to be blinking. Everybody seems to be okay with that.
Yeah, Roger, it's interesting. In the lead up, you used the word that investors are hopeful. And, we've all used that adage before, is hope is not an investment strategy. But it's difficult for investors in this environment because it's such a binary outcome market right now in terms of the way the war is driving it. Because either you have worries about the war, and then immediately what you have is oil will go higher. The oil stocks will be the only thing going up. The U.S. dollar will rise as a safe haven. Commodities will fall, particularly gold, and risk assets will go down. So that's outcome number one. And then outcome number two, which we've seen more of in the past 2 months on this hope, is just the opposite of that, with oil lagging, oil stocks lagging, oil coming down, the U.S. dollar losing little steam, commodities rising again, and stocks doing better. It's anyone's call on that. I think the optimism is a little misplaced. Like I sort of look at it and I say, Trump made an announcement on the weekend, a pronouncement that they're close to a deal, and maybe they will get some sort of deal, just like we saw, after Liberation Day. But I think effectively all you'll do is you're going to be kicking the can down the road, and maybe it'll make markets rally. But if it did, I'd probably be fading that rally, because I think when you look at it, and maybe you step back a little bit, Roger, I think the U.S. strategy at all of this, it was after they did the bombing of Iran last June, and then, successfully ousted Maduro from Venezuela. I think the idea was, listen, Iran has no military superiority in any way. We're going to go in, we'll do this, we'll go in and get to uranium, we'll change the regime, and everything will be fine. And I think what has happened on the other side is Iranians have woken up to the fact that they have a power they maybe didn't realize
But
they had before, which was the choke point of the Strait of Hormuz. So this is going to go on longer, I think, than most people expect. I mean, it took them 8 years to get out of Iraq. And I think, Roger, the biggest thing we have not seen yet, and we will start to see, is you're getting very, very close to the tightening of the actual physical oil market. You had a lot of oil at sea at the beginning that's floating around. They're able to make deliveries on a global basis. You've run a lot of that down now. There's no excess inventories kicking around.
But is Iran not feeling that as well, though, John? I mean, they must be feeling that pressure because oil is everything to them. I mean, what else do they don't really export much else. Oil is everything to them, and they need that money. And if they're slowing down as well, they must be feeling the pinch.
Oh, absolutely, they are, and they're getting bombed completely as well. But I mean, they seem to have a more of an ability or to take this over a longer term basis, and their strategy was in place longer. I mean, in the U.S., quite honestly, I mean, most of Trump's decisions are driven by personal, political, or financial motivation, in my view. And they got the midterms coming up that they don't want to lose, so they've got a tighter timeline on that. Iran is longer. The other thing, Roger, that I don't think anybody talks about in terms of the nuclear capabilities is that I'm sure Iran sort of casts an eye at North Korea and says, why is North Korea, even though they're not as invasive on the same basis, why is, they left alone to a greater degree? Because they've got some nuclear capabilities. So that's not lost on Iran. So in the end, the best you may get out of this is something similar to the JCPOA, which was the first thing that Trump ripped up when he got into office. So that's a long way to get to nowhere. So for now, markets are fine. Markets are sort of loving. They're optimistic about this, but you start to get, this kick the can down the road agreement, I'd be loading up on the oil stocks again, and I'd probably be fading more of the stock market rally, and just despite the earnings growth.
And how much? Yeah, I was going to say, how much is earnings playing a role in that? People are looking at. I mean, they had a great quarter. Most everybody had a great quarter by the looks of it.
Yeah, no, the earnings have been strong. They beat expectations, and certainly because the economy has been strong. It's you've got a few tailwinds going, and we talked about that, and that's allowed profit margins to rise a little bit, and the U.S. in particular, where the earnings growth has been stronger, it's a little more insulated so far from what's going on in the Middle East. I mean, a lot of the other economies closer to that, Europe and Asia, are much more affected immediately. So these impacts will come through, Roger. It's just so far they have, and so far markets are celebrating that. But at the same time, you got interest rate cuts are off the table right now because of higher inflation rates, and valuations are climbing back up. So there's a lot out there to make me a lot more nervous. But I'm always seeing the glass as half empty on this basis. But I'd be I'm less concerned. Having said that, Roger, there's one thing you in that story, and I don't know anything more about the story, but you mentioned in your lady that little story about more private money coming into Canada, the one deal you talked about into the energy sector this morning. That's key. I think you're starting to see a real flow. I mean, Shell buying ARC Resources was the first. That was a reversal of something we've seen for like 12 straight years of money going out of Canada. I think that's huge. I think money's coming back into Canada. That is a positive for our market. But I think the energy and related sectors will be the biggest beneficiaries of that. So don't even if they get hit a little on a potential agreement or the outlines of an agreement, I would not abandon the energy trade at this point.
Yeah, Northern Oil buying 25%, 350 million Canadian. Parallax Energy, oil producing properties in their tens of thousands of acres as well. So it's good to see that money coming in. We need to take a break right now, John, but I know you're sticking around. We've got lots more to talk about, including what seems to be the growing gap between weak consumer sentiment and strong expectations in the stock market. We'll have more after the break. All right, let's see how things are shaping up on the markets. We'll start with U.S. futures and take a look at that. That long holiday weekend. It's got some pent-up energy ready to go by the looks of it. You can see the Dow's pushing 51,000. The NASDAQ may hit 30. It's up 1% in the futures right now, and the S&P 500 up by 0.66%, up over 7,500. And heading to Asia now. And a bit of a mixed bag there. The Nikkei was off by a quarter. Hang Seng pretty much a wash. And then you can see the CSI 300 up by about a half point. All of a sudden, what's unfolding on the uncertainty in the Middle East? Similar situation when we go to Europe as well. And you can see the FTSE rallying nicely, up almost a half point, but the CAC 40 off by almost 0.8, and the DAX off by about a half point, again, on all the uncertainty in the Middle East. And the TSX hit a record yesterday, 34,830, up by more than a full percentage point. It has had a nice rebound since that dip. It's now surpassed the high in March. And who were some of the movers and shakers? Yeah, it was mostly in the materials. They were up 4.35% yesterday, led by Hudbay Minerals, up by almost 9%. First Quantum Minerals, 8.36%. Now, the only negative index was energy, and you can see it showing up there. Baytex off by 5.2%, and Tamarack Valley off by 5.25%. Taking a look at metals now, and you can see gold off slightly, still above 4,500, but down by a quarter point. Silver pushing up again at 76.31, up by 0.15, and copper still holding solid, up slightly, 0.12% at 6.39. And oil, let's see what it's doing right now. And WTI is down at down 4% right now, 92.64. Consumer sentiment surveys are near record lows, while investor expectations for higher stock prices remain elevated, pointing to a disconnect between households and markets. Let's see what's causing the disconnect. We'll bring John Zechner back in from J. Zechner Associates. John, what are your thoughts on this? What's unfolding here? We have optimism on one side, pessimism on the other. Half full? Your glass half full?
Yeah, I'm glass. Yeah, only half full, half empty. Roger, I mean, yeah, it's quite the dichotomy, because, I mean, the story used to be is the economy would drive the stock market, because the economy drives earnings drive stock prices. And to some degree, you talked about that in the last segment, the way earnings have been strong. But it's just interesting right now when I look at U of Michigan and the Conference Board surveys came out last week again, in the most recent. And in both cases, they have moved to all-time lows, like not recent lows, not, we're talking about all-time lows going back 7 years. This is below, COVID. This is below the financial crisis. And I thought that is, desperately bad consumer confidence. And then on the other side, you've got the expectations of the highest, supposed to 60% expect stock prices to be higher in the next year. The holdings of stocks in the U.S., by most of the measures I've seen, over 70% of portfolios right now, which is, again, the highest level ever. So people have this believer. So how do you, sort of rectify this dichotomy, or how does it resolve itself over a period of time?
I was going to say, how long can this continue before they split apart entirely?
Yeah, or which one breaks down? I think you have to look a little bit more at that economic data. Why is it so strong? What's driving it versus that consumer confidence level? And I think a lot of it, first of all, the AI spend. As we've talked about before, the 4 hyperscalers alone are, $700 billion. Then, it's basically $1 trillion of tailwinds from the capital spending on AI, which is that explains 40% of the growth in the U.S. economy last year. That exceeds what you saw in the bubble in 2000, where it didn't even get to 30%. So that is a massive, massive tailwind. On top of that, you've got, governments everywhere are spending like drunken sailors. I mean, Canada's doing it and upping it because we have to on a global trade basis.
I don't know if you heard our numbers. We've got the highest debt. We're at $3.4 trillion across the provinces.
Yeah, no, you're right. I was thinking
Ottawa.
The same thing, Roger. And what's interesting too is I think you mentioned the same thing. I think that gets on a combined basis to 85% of GDP. The U.S., which are usually a 10-to-1 ratio on, they are at 36 trillion, and they're over 100% of GDP. So they're even worse on that basis. But all that spending is, again, an economic tailwind, the big beautiful bill in the U.S. So you got these factors that I don't know that's sustainable for long periods of time. And the third one that's driving the economy is the wealth effect. And again, it's, that's tilted more to the, the wealthier end of the population. They're the ones, because their stock market's going higher, the value of their investments are going higher, and they're running down their savings rate, and that is sustained at this penny. So you got three factors that are good tailwinds for the economy. They're sort of concentrated in sort of the higher wealth areas, not across the whole economy, that are, maybe not sustainable. On the other side, you've got the average consumer, middle class, lower income. They're way more impacted by higher food prices, higher gasoline prices, and that's where you're getting these really, really negative sentiment numbers. So, how it resolves itself, they will quite, move back together at some point, because ultimately, like I say, it's the economy that drives the stock market. But for now, you've got, a very explainable, but an odd type of dichotomy between the economic data and the consumer confidence data.
Have we seen 2008, dare I say the Depression, have we seen points like the market crash of 29? Have we seen points like this where it was the divergence was so clear?
No, not really, Roger. Because, like I say, the consumer confidence data, the Michigan survey, is an all-time low, and that was, I think they started that after the Second World War, so you don't get the Depression in there, but you certainly get 2008, but I remember 2008 markets very well, and yeah, I mean, consumer confidence and investor confidence were both at absolute low levels, and I mean, I'm not the type who get excited about the stock market. I'm a glass half empty more type of person all the time, Roger. That's the last time I remember being very, very bullish, was back at that point. But because of that, the economic data was low, interest rates were falling, the economy was going to pick up at the same time, investor sentiment was very low. I like that combination. Right now, you got the opposite mix. It concerns me a little. Maybe not as much sustainability on this economic growth because of those tailwinds that may not last. On the other side, consumer confidence and the economic data is not that stirring.
And what are you doing with this?
Well, you can't change your whole philosophy based on anything like this. I'm still, we're invested as we typically are. We're in the middle of the range. I'm just looking at more defensive positionings. I look at things that when I look at a stock more, you want to know what the upside is in the growth. I also want to know what's my protection on the downside. Is why I look at areas like software lately, Roger. I know they've become like a defensive play. You notice on the down days in the market, they're the ones who act a little better because the valuations are already so low. So our portfolio is structured right now that at least I can participate on the up days or in line with the market. So we're sort of there, but we pick up a lot more performance on the down days, that's for sure.
All right, we'll wrap it up on that note there, John, but we've got lots more to talk about. We'll see why Whitecap Resources is on your radar. That's coming up after the break. Time to see what's on the radar for John Zechner, chairman at J. Zechner Associates. And first up is Whitecap Resources. What are you liking about that, John?
Well, specifically on Whitecap, Roger, the acquisition they did of Varen Energy is looking very timely. I mean, a lot of people talk about Cenovus and Meg Energy, which, is accurate. I mean, buying Meg last year was tremendous because, oil prices were in the low 60s at that point, and, now they're well above, 90. So that was a great acquisition timing-wise. But when I look at Whitecap, I think it's been out 2 years ago that they bought Varen, and they bought great assets at that point in time. And, they're bringing them into the fold online as well. And on top, they got great properties, light oil in the Duvernay, Montney regions, which I noticed that agreement we mentioned earlier was sort of in some of those regions as well. One of the more prolific productivity fields in Canada. So they good management team, good balance sheet, and now all of their free cash flow is basically going back to shareholders in terms of dividends. And they got over a 4% dividend yield as well as stock buybacks. So you're getting shareholder returns directly, and it's a decent play. That I think the fifth largest oil producer in Canada now, probably less discovered, a timely purchase, and I just think this oil sector is underappreciated. We've seen nothing but money go out of Canada for over a decade now, and we're starting to see a reversal of that with worries about geopolitical risk globally for oil supplies, and Canada just sits as a great alternative for foreign investors. So I think this is is just the beginning of seeing these money flows back. And certainly, Suncor and Canadian Natural and Cenovus will stick out as the big liquid plays. But you go a little further down the curve and you're finding great names. And Whitecap really sticks out as, I think, the top name on that because it's more oil leverage than gas leverage as well.
So you really think this the Middle East crisis now it will be enough to it'll stick. This one may be the one that sticks. We've had situations before, and you get interest and then it fades once everything goes back to normal. But you think this time around people are really taking a serious look?
The financial players go back and forth, and that's why the front end of the curve has been a lot more volatile in oil than the back end. But you notice the back end of the curve, like December and further out futures, keep creeping higher because that's the physical tightness in the market. I mean, you've really cut off so many physical supplies, like I talked about earlier. This will sustain longer, I think, than people expect in the stocks. Yeah, oil will go back, but I mean, even if you went back into the $75 to $80 level, you settled in, it's still way better than we were. And these companies are extremely profitable at that level. So that's what I like to see. I look at the downside, what's your protection here? I don't think we're going back to $60 or $65 a barrel, anytime soon, that's for sure. So, maybe if all of this gets settled, but I just, like I say, these things last longer and take longer to unwind than expected. And I just go back to U.S. went into Iraq in 2003. It was 8 years before they really got out of there completely. And Iraq wasn't a choke point for global oil supplies like the Strait of Hormuz is.
All right, let's get a couple more in. Torex Gold.
You know what? You got to stick with the gold bet in my mind. I just think what you talked about, Roger, earlier about government spending. I think you're going to continue to depreciate the value of fiat currencies globally, and the U.S. dollar will be the lead in that. And I think central banks are telling you that, and they're diversifying, getting into real assets, including gold. Like crypto might ultimately be a destination as well. I'm just not brave enough to go down that road yet. But I think gold will sustain itself in these ranges. So you look at stocks like Torex. I mean, trading at 3 times operating cash flow, about 40% of net asset value. All of their assets are in Mexico right now, which I really don't worry about geopolitically outside of the Sinaloa cartels or something like that. And they've migrated to the new mine on the Media Luna on the Morales property after they had to shut down the Limon. They've gone underground on the same property as well. So they built out the reserve to the mid 2030s at it incredibly cheap. And I think you should have some gold in the portfolio. This one sticks out to me as a somewhat large cap, growth oriented, cheap play.
All right. And Constellation Software, which has been on a ride, hasn't it?
It really has. And I wasn't we didn't really own it over the years. I always found it too expensive, but it kept going with the acquisition story. But now, I mean, we're talking about 10 to 12 times operating cash flow, a better environment for them making acquisitions. And I just think the whole worry about software getting decimated or eradicated by the onslaught of AI is just misplaced. It's almost like it was with, Alphabet, a year and a half ago, that search was going to be displaced completely by AI. And look at, that's been a great stock. I think the same thing for the software stocks. They're cheap. I think the valuations are attractive. I think the environment for them making further acquisitions is ripe, especially with private equity not being as pervasive as they were. And despite the Mark Leonard going, I think they've got a very deep management team, and acquisitions is how they've done this historically. And they're so broad. They got vertical integration, but they're so distributed as well. I don't think they're at risk that a single application, can be pulled out and replaced by AI, and that's where your safety is.
And I always ask this with Constellation. I mean, could they pivot and go in a different direction? I know they do software now, but if they have a good management team that knows how to buy companies, can they just buy different companies? Could you see that ever happening?
Well, at that point, I probably get a little bit worried. So stick with the game plan that got you there. And, and they're diversified. They're moving a little bit away from this with this new, I forget the acronyms for it, but the strategy of buying smaller interests, like minority interest in companies, and trying to influence them a little bit more. I mean, I'm not as convinced on that strategy. That becomes a bigger part of what they expect in growth. I wouldn't be as happy because you're not getting the cash flow from that investment. Right now, they buy these smaller companies. They get all the cash flow. They generate a lot of free cash flow to make more acquisitions, and the story feeds upon itself. If you start going in a different direction where you're not getting the cash out of the asset, that would worry me a little bit more. I don't like companies that change their strategies on a strategy that has worked successfully for a long period of time. That's always a risk.
All right, we'll wrap it up there, John. Lots more to talk about coming up. Next up, we're going to look at how the FIFA World Cup, Men's World Cup, will impact Canada's economy with our next guest, and Our phone lines will open soon for our first call. You can reach us at 1-855-326-6266. Send us an email, first call at bellmedia.ca. Shares of BP are down 6% in the pre-market. The oil and gas company's board has removed its chairman, Albert Manifold, effective immediately, citing serious concerns about governance oversight and conduct. Manifold only took over as chair in October. His removal comes as the company was supposed to be turning itself around after years of poor performance. BP says Ian Tyler will take over as chair on an interim basis. Shares of Ferrari are down in the pre-market. So fun to say, after critics took a look at the car maker's first fully electric vehicle. The unveiling of the Ferrari Luce drew largely negative reactions from industry analysts and social media influencers. The design of the $640,000 US EV is being compared to mass market EVs. However, with a remarkable top speed, driving Ferrari's Luce might deliver different views. American firm Northern Oil and Gas is acquiring a stake in Calgary-based Parallax. The $350 million cash and stock deal between the two privately held companies will give Northern a 25% interest in light oil-producing properties and 75,000 acres in the Duvernay Shale Basin in Alberta. Under the agreement, Parallax will continue to operate the assets owned by Northern. And a quick peek at the markets, and you can see the U.S. futures after that long weekend ready to go, even with the concern about possible attacks and retaliatory attacks in Iran. Dow up by a half, NASDAQ by more than 1, and the S&P 500 up by 0.7 right now in the futures. Well, FIFA estimates the upcoming World Cup will deliver about $3.8 billion in economic output for Canada. Representatives of the country's hospitality and tourism sector are also anticipating a lift. Here to discuss that and more is Sarah Angel, President and CEO of the Greater Toronto Hotel Association. And Sarah, thanks very much for joining us.
Good morning. Thank you.
How is it looking right now? FIFA booked a bunch of hotels, then they freed them up. Are those being filled by people who are coming in for the games?
Yeah, I mean, the blocks were dropped pretty much across all 16 cities across North America back in April. And so I just want to point out that June is usually a very busy month for the hotel industry across the country, across North America. So what was a great June in a non-FIFA time can become a more difficult June because all of the food and beverage outlets and all of the citywides and business events are staying away from the city. Having said that, we are seeing that we have a lot of transient coming into the city, and the month is looking okay, but not as great as maybe we would have expected without the FIFA block dropping.
John, you want to join in?
Yeah, I'm sort of curious about one thing in terms of the international visitors coming in for these the events. Do you think there's been any impact? Because we went to book some travel recently, and I'm just astounded how much airfares have risen, obviously because of the cost of jet fuel. Do you see any impact on that already on the hotel industry in general? That travel from foreigners coming into Canada for a variety of reasons, obviously, but mostly because of higher fuel prices, has been any sort of an impact yet?
Absolutely, it has been. I mean, all the geopolitical issues that we've been experiencing and oil prices and people taking longer to make decisions due to costs are all part of the impact. Another impact is, if we think about it, to host a FIFA World Cup across 16 cities, it can be a little bit challenging. While exciting to see all the different cities, when you're looking at fan base coming from international or across Canada or even the US, fans and tourists are going to think twice about their decision to follow their teams around if they have to, go back and forth to a bunch of different cities across North America.
It isn't a tiny continent, is it? I mean, that's a lot of travel involved if you want to follow your teams Is this what kind of we have? I mean, Toronto has so many events. Pride's coming up this month. That's all are coming up in a month. How are is it having an impact on bookings for that at all? Are we seeing any concerns about that?
Yeah, well, actually, that's a great point that you raised. We have the Blue Jays, lots of games with the Blue Jays in Toronto and Pride Parade and a whole bunch of other events, which are actually helping keep June a relatively strong month for the city.
One question I've got, this, and I live in Collingwood now. I come down to Toronto for work, but how has the nightmare of traffic in Toronto, particularly over the past year or two, making getting around difficult? Have there's been any dealings with the city to sort of lighten this impact during FIFA, just in order to make getting around any easier? Because that's going to impact travel as well.
I mean, the city would be the best person to ask that question directly, but definitely have seen a significant amount of effort put into getting people to and from the field during game time, and of course, Fan Fest. So there's public transit is heavily been elevated with lots of extra buses and trains going all around. And of course, fans who choose to come in for the games who are not from Toronto, they have a multitude of options for hotels to stay at. They don't have to stay in the downtown core. They can stay out in Mississauga, Vaughan, Markham, and have great public transit accessible to the downtown.
From a business side, is this almost a little overhyped? I mean, we have Bruno Mars in Toronto right now, and he's doing, I think, 5 or 6 shows and selling a stadium that's 50,000. How many people are we expecting from outside just to come in to either see the game? I mean, the game is what, 45,000 maybe, and then all the events that are around it. How many people are you expecting to see for the games?
Well, I mean, the city's projected 300,000 fans. That remains to be seen. I mean, to your point on Bruno Mars, I was just visiting a hotel last week, and they were almost completely sold out for the whole nights leading up to Bruno Mars and beyond, because the production crew were staying at that particular hotel. So there is still an amazing buzz in the city with lots and lots of events. And we are excited to have the 6 games here in Toronto. And I'm sporting my great Toronto scarf for the game, and we are cheering Canada on.
And now, you one of the notes you said you call it 6 Super Bowls. Does it still feel like it'll be 6 Super Bowls, those games?
Well, maybe a little smaller, but that's kind of the comment that I've been using, that it is 6 Super Bowls, and Toronto's never seen anything like it. And we stand to see a lot of positive aspects coming forward in future years when Toronto and Vancouver are on the map internationally as great destinations beyond FIFA.
Is that almost more important? Is that advertising for the city itself and the country? But is that more important than having bodies in hotel rooms over the games?
I think it's all important. It's, of course, having people stay in the hotels. We want the hotels to be busy and profitable and providing economic impact to the economy in Canada and the Greater Toronto area. But the legacy pieces that have come with FIFA, as well as the long-term positive effects. I mean, I myself, sitting in my living room last summer watching some beach volleyball from the Paris Olympics, there's the Eiffel Tower behind them. And that's on my bucket list again for the next 5 years. And I think that a lot of people will discover Toronto, even if they haven't come to Toronto and Vancouver, and we'll see that piece of tourists wanting to come to Toronto and Vancouver.
And so the long-term impact, I mean, the FIFA saying $3.8 billion for all 3 countries. So you feel we will get that money eventually?
I'm optimistic that we will.
All right, Sarah, thank you very much for joining us today. Appreciate it.
Thank you very much.
Sarah Angel, President and CEO of the Greater Toronto Hotel Association. Still ahead, today's market drivers with Bloomberg's Arvalis Bonilla Ramos, and our phone lines are open. John Zechner is taking your questions on North American large cap stocks. Call us at 1-855-326-6266, and you can email us. First call at bellmedia.ca. A South Korean submarine docked in Victoria for joint exercises and to showcase its bid to replace Canada's aging submarine fleet. CTV's Adrian Gobriel has more.
Promising to usher in a new era of middle power might, the Republic of Korea Navy cut through Canadian coastal waters this weekend.
Be safe!
On board its KSS-3 submarine, a bid is in place for Canada to purchase 12 of these South Korean-made subs. The only other finalist vying to deliver Canada's next-generation submarine is a joint German-Norwegian bid. Ottawa will announce the winner of the contract this summer, which could come with a price tag of $25 billion. Korean Navy gave CTV News a tour inside the submarine that could be the centerpiece of Canada's naval future. We were forbidden from taking any of our own video inside. Korean Navy provided footage shows their crew in action. The submarine is more spacious inside than Canada's aging fleet, with the capability to deploy both anti-ship and land attack cruise missiles.
The South Korean KSS-3 is 89 meters in length. It weighs 3,600 tons, can accommodate up to 50 personnel, and stays submerged for up to 3 weeks.
I just want to say thank you.
One of two Canadian submariners who traveled with the Korean Navy shared this analogy when comparing the Korean sub to Canada's.
It's kind of like buying a brand new Tesla, and then you're coming out of a '99 Honda Civic.
The Canadian Navy's 4 Victoria-class subs were first built in the 1980s. Only one is currently operational.
You have 3 oceans to patrol. How difficult does that make your job?
I do not have enough ships to patrol and to protect Canada like we should, which is why we're investing.
Currently, the Canadian Navy has approximately 200 submariners. They will need at least 1,000 strong to operate a fleet of 12 submarines.
This is all about democracy and freedom.
The ambassador of the Republic of Korea to Canada believes his country is well positioned to help protect Canadian coastal sovereignty.
Middle powers need to work together, and Korea stands ready to work together with Canada.
In increasingly troubled waters, the Canadian government is focused on forging friendships as it rekindles historic military alliances.
With a decision expected as early as this June, whoever is chosen to deliver Canada's next-generation submarine is poised to play an integral role in shaping the country's Navy for decades to come. Adrian Gobriel, CTV News, CFB Esquimalt.
We'll have more on BNN Bloomberg coming up after the break. Let's take a look now at some of the early market movers. And for that, we're joined by Bloomberg's Arvelis Bonilla Ramos. And Arvelis, thank you very much for joining us.
Thanks so much for having me.
All right, we are talking space stocks. They're all getting they're getting a nice little boost courtesy of SpaceX and the IPO.
Yeah, their reaction throughout the stocks today, it's really out there. I got into the office and I was really surprised with how they, not to sound like this, but they've been taking off this morning for sure.
You've been waiting all morning to use that, haven't you? How much are they taking off by? Are they at the liftoff, or are they up into outer space? And who's leading the way?
Well, right now you have companies like Satellogic, Redwire, sort of like leading the pack, Firefly. And these are companies that throughout the year has seen also positive boosts based on, the euphoria around SpaceX IPO, but also the euphoria on the space itself and how, these companies are sort of like being given sort of like textile valuation. So there's a lot of excitement, not only from analysts, but also from people who want to tap into the market now that they see that SpaceX is sort of like bringing this sort of aspect into the table.
And ICMDA space, and they're always nice to mention a Canadian company. They've gone up nicely. I was taking a look at their numbers. I think they're up like almost 50% in the last month.
Yeah, we had, and you can see those numbers too, Redwire, and this is today, this morning, 13%, 12, 11%. That's really significant. Also, thinking about what space was a couple of years ago. So people feel aside from the excitement and the euphoria of what could be, they feel like these companies now, there's less skepticism. These are companies that can really bring something into the table.
Okay, we have to wrap it up there, but Arvalis, thank you very much for joining us.
Yeah, of course. Thanks for having me.
Bloomberg's Arvalis Bonilla Ramos. Let's take a look at some of the notable analyst calls and recommendations. Watai Research initiated coverage on GE Vernova with a buy equivalent add rating, citing the company's central position in the energy transition supercycle. The positive outlook is driven by surging AI-accelerated equipment demand and critical infrastructure modernization. TD Cowen has upgraded Gibson Energy to a buy with a price target of $32, signaling roughly a 10% upside potential. The firm citing the upgrade is driven by an improved risk-adjusted return profile supported by stable infrastructure earnings and strong export potential. TD Cowen has upgraded Pembina Pipeline to buy with a price target of $75, driven by a strong Western Canadian infrastructure volumes and an upward revision to guidance. Let's get John Zechner's commentary on Pembina and bring him back in here. John, your thoughts.
Hey, Roger, I need you to say Ferrari a few more times.
Ferrari. You got to roll. You got to roll with Ferrari.
Actually, on that last segment as well, the reporter you were talking to about the MDA space, that's just astounding. I mean, I sort of, we owned it and all of that, but I'm, the valuation is really getting a little concerning but you're right, it's just so much bullishness around that right now.
A lot of excitement. I think it's excitement almost more than bullishness, like that. It's emotion.
It is, you're right.
It's space.
And they got the low Earth orbit satellites, and they've got the space arm and the others. So yeah, clearly this is the next realm of spending. And as you said, SpaceX is just bringing that to the forefront.
All right, Pembina, you got 30 seconds.
Yes. Just more of the upgrades. I mean, I think TD is a little late to the game on upgrading this one. I mean, everybody has liked this one for a while, and they are a little bit more. I mean, everyone sort of follows Enbridge and TC Energy a little bit more, but Pembina is sort of the great third player in terms of pipelines, gathering systems, and I think have more of an ability to sort of grow and make acquisitions for any of the further expansions. So, there's been a nice play, decent yield, and a lower valuation as sort of the bigger players in the group. But stock's had a tremendous run and has broken out of a range, has been in it for quite a while. So I don't, I'm a little surprised that, TD is sort of upping the target that much. Maybe they're just trying to, stay in the game with the valuation a little bit more.
All right, we'll wrap it up there. Jump, lots more to talk about. When we come back, we'll see you take your people's questions on First Call. Easy for me to say. John's going to take the questions. I'm not going to try and answer them. First Call on the Street's up next. All right, time for First Call and first email. And for that, we go to our email bank, and Anthony's there saying Canadian dividend stocks like bank insurance, utilities, pipelines, they've gone up substantially in the past 2 years, but earnings have not. Could the recent decline in real estate speculation, especially condos, have led to rotation of capital to these dividend stocks? Is there a Canadian stock market bubble? John.
On that basis, I don't think so. I mean, the valuations of it, and it's a good point. I mean, certainly the bank stocks, which are great dividend payers, are at record valuations, which means the yields have come down. We just talked about the pipelines earlier. They've also done that as well. So I think, people have to cast the net a little bit wider. What we started looking at more recently, which good dividend payers, are the telecom stocks, and they've been out of favor and the valuation is lower. So I think they're attractive on that basis. And we started looking at the REIT sector as well, because again, it's more of an income return, and the valuations have not moved as much there. So I wouldn't call it a bubble in income stocks. I mean, only to the degree that you would worry that interest rates were going to head higher. I don't think they are going, much higher from this point. But I don't think the bubble in the market is in those areas. I think it's more in the real speculative areas when you talk about a multi-trillion-dollar valuation for an IPO, and we were just talking about that. That's where I get a little bit more concerned.
All right, let's get another email in here from Umesh. What is your guest's opinion of investing in uranium and nuclear stocks for a 5-year hold as the need for increased energy demand, specifically electrification, is growing?
Good idea. Yes. And you quite honestly, we've got a couple of plays in the sector. What really sticks out is the biggest mismatch is in the commodity price itself. I think if you say, what are the commodity you're most bullish on, I would say uranium. There's no way in the world that, the supply demand mismatch right now. Inventories have been run down. When you look at the growth in nuclear capacity over the next number of years, particularly out of places like China, you're going to be an increasing demand with no increase in supply. In order to bring that new supply in, you're going to need a higher price. You're not going to have uranium at $85 a pound. So, we're playing it more directly to, the Sprott Physical Uranium Trust or something, plays like that. But you could certainly play it through, Cameco, even though it's a higher valuation. And then obviously the engineering companies that are building, the physical assets. I mean, Atkins Realis has been a great, play in that regard. So this is real. I mean, this is happening as an alternative. It's a safer form of energy now, believed to be that, and less carbon intensive, obviously. And you're getting just more of a global move towards it. I mean, the biggest mistake I think, Germany made was shutting down their nuclear reactors, and they said that Japan has restarted every single one of their nuclear reactors, or in the process of doing so. So it's coming back online. Demand will be there, and you just need more supply. So uranium looks good, and the sector looks good.
And do you think Canada can lead this still? I mean, we were a leader for a while. Do you think they can lead it? We got about 20 seconds for that.
The CANDU reactor is still, one of the premier product. There's some, talk about capability, higher capacity from other types of reactors, but CANDU is still front and center on these. So, yeah, we are still a good technological lead, and we are still there.
All right, John, we got to wrap it up there, but thank you as always for joining us, sir.
Thank you, Roger.
All right, John Zechner, Chair at J. Zechner Associates. That's it for us here on the street. Lindsay's up next with the open. Trading gets underway about 30 minutes from now. Have a great day.